the confusing parts over this past, let's call it since the global financial crisis, that has thrown a lot of people off, is that they assume money printing must be inflationary. Whereas another way of looking at it is that it can be anti-deflationary.
Right.
That you don't you don't assume that the base case is like roughly zero inflation. You might assume the base case is deflation in a certain type of environment, like a big debt bubble going off. And when you expand the monetary base, you set off a series of changes that prevent that deflation from happening, which is, it's another type of inflation, but it's not something we would generally think of as inflation.
Since 2020, one of my main themes has been that the fiscal policies we are experiencing this decade would be inflationary, and that, unlike previous business cycles, interest rates may not be the greatest policy tool to deal with that inflation. While that is right, the issue has been navigating the precise road as we go through the different twists and turns of such an unusual macroeconomic climate, according to Lyn Alden, an independent investor and macro expert. According to Lyn Alden, when sovereign debt is low and bank lending is the primary source of money creation, higher interest rates accomplish exactly what we expect them to do: slow down loan creation and inflation. When government debt is large and as much money creation occurs through fiscal deficits as it does from bank lending, higher interest rates have mixed impacts because they reduce private sector lending while also increasing the deficit by an equal amount. However, when government debt is extremely high and fiscal deficits generate significantly more money than bank lending, higher interest rates can become openly positively associated with inflation. The United States is roughly in the second category. We're on the verge. Annual fiscal deficits already exceed annual loan creation and dollar size, but due to the muted proclivity to spend interest income, the two forces appear to be roughly tied and possibly still leaning towards loan creation having more weight. Let us now proceed to the film, where Lyn Alden discusses monetary policies, the inflation and deflationary systems, and the depiction of the Bitcoin to dollar proposal. While you're watching, don't forget to hit the like button, subscribe, and leave your thoughts in the comments section.
Generally, what these environments shared is that, leading up to the Great Depression and leading up to 2008, you had a situation where the multipliers were very significant, meaning that the number of deposits that a bank had that they owed liabilities in compared to how much base cash they had was very wide. And also
But
how
how are
much
you measuring that cash?
different ways. You can either look at just deposits in the system compared to the monetary base, or you can look at deposits in the system compared to the amount of money that banks list as cash, which is either vault cash or bank reserves. If you're on like an older money standard where, say, the money is gold, right? If something unravels this big debt environment, you can't print more gold. So you're going to have some sort of peg break. You're going to have some sort of deflation, either deflationary collapse or peg break. It's kind of your options start to condense down. Whereas what makes this money printing essentially is that now authorities have flexibility over the monetary base. So the third option is that basically instead of a peg break, they can maintain those claims because they increase the monetary base and they make banks less reliant on interbank lending. But then it kind of retroactively makes all of their deposit growth and their fractional reserve banking, it kind of solidifies that. It says that is now, we've given the choice between M2 starting to collapse down closer to the monetary base or the monetary base expanding upward to meet M2. They basically say that we will always err on the side of, the monetary base expanding upwards to make most M2 money good. What you generally have in these crisis environments is that you have an inherently unstable system. Like, basically that no more than 5% of people could want to withdraw cash at once because there's really not, the base cash isn't there. There's only so much base cash. If the whole system's only levered so that there's basically, like back in 2008, there were like 23 deposits for every $1 in what banks called their cash, which is like vault cash combined with some reserves. Now, if any one bank, let's say one bank had 20% of deposits want to come out of it in one day for some reason, maybe they have a really big concentrated depositor. That bank could meet that no problem by going over to Wells Fargo and saying, hey, we just got to meet this like liquidity requirement. But if the whole banking system were to, one, seize up so they can't, they don't trust each other anymore.
But that's an increase in counterparty risk.
Yes, but the reason it happens is because they realize like that the money's not actually there, or at least most of the money's not actually there. So if the music stops and if, say, 10% of the whole deposit base shows up and says, oh, okay, I want my dollars right now, there's literally one is there's not even enough printed dollars. And two, even if you include reserves and things like that, there's not that many base dollars. So there's a difference between reserve accumulation and actual backing. So reserve accumulation would basically say, okay, our Federal Reserve is going to be, and Treasury, actually more specifically, is going to be allowed to and even tasked with increasing its hard assets, right? So you say, okay, instead of just holding our 8,000, supposed 8,000 tons of gold flat, we want to go out and buy more. And, we want to add a certain percentage of Bitcoin to that mix as well, so that there's more reserves in the system. That's one statement. I think it's an arguably reasonable thing to do. I mean, it's probably dollar negative while it happens, um, but then they'd have more ammo if they should ever want to defend the dollar. That's just generally how emerging markets manage their exchange rate. Is they either one of the things they do is expand reserves or contract reserves. So that's an option. Now, if you actually wanted to back it in terms of redeemability, the challenge is that you have to have quite a lot of it. So
Yeah.
the way this
Yeah.
would work on the gold standard, for example, is that you might have 40% of your monetary base backed up by gold. And if there's too many redemptions happening, that's what you'd have to increase interest rates, because you want to entice more gold to enter in or at least you want to stop the outflows and entice more existing gold to come back in for people that say, okay, I trust the system and I want to get that higher interest on that gold by depositing it. And then if they're ever in a situation where they have more gold than they need, let's say they have 50% and their mandate's 40%, they can cut interest rates because it doesn't matter if there's a little bit more redemptions happening. But you can't generally do that when you're talking about 1%, 5%. And the longer term challenge goes back to our earlier point about fractional reserve banking and how these claims tend to proliferate faster than the underlying base can.
Right.
And so when you have banks that are not full reserve banks, so they're not doing duration matching, they're doing fractional reserve banking, they're generally increasing the total claims in the system more than gold's increasing. And so as long as that's redeemable, you're probably going to get drained. If you look at the Bretton Woods system, it's interesting because it was proposed in obviously 1944, but it wasn't fully implemented until the late 1950s. That's when like it was fully set up. The exchange rates were like um,
We're
like all,
locked.
all yeah, all that stuff was like, yeah, it was kind of all planned for like that first like 15 years, and then it was like, okay, we're going live. And if you look at U.S. gold reserves, they just started dropping almost every single year like a stone. As
Yeah.
soon as, soon as you had that, until it just broke. Then they said we can't do this anymore. So a lot of people, when they look at the Bretton Woods system, they say the problem happened in 1971. It's like, well, no, the problem happened the second you went live with a system that didn't fundamentally make sense, because you didn't constrain the number of IOUs, bank deposits. You didn't constrain the number of euro dollars. So you had fractional reserve banking built on fractional reserve banking. This was all
No
proliferating,
reserve
and
banking,
yeah,
for
and
heaven's
all
sake.
this was yeah, and all this is now redeemable for gold. And so people kept saying, well, I'll take the gold then. So you started rapidly draining gold while increasing M2 and increasing euro dollars, and eventually the ratios got silly and broke.
El Salvador's bonds due in 2027 have increased by more than 60% since the beginning of the year, paralleling the cryptocurrency's price increase of 80%. A government bond is a debt that the government issues and sells to investors to fund government spending. El Salvador's debt rating was downgraded by credit rating organization Fitch Ratings in September 2022, predicting a debt default in January 2023. A debt default happens when a borrower is unable to repay loans, implying that El Salvador will be unable to pay bondholders. Not only did this not occur, but the country repaid a bond in the amount of $800 million in January. Since then, the country's bonds have risen in tandem with the price of Bitcoin. Despite the fact that other variables are at work, including investors applauding the appointment of veteran IMF official Alexandra Werner as a finance ministry advisor, El Salvador proclaimed Bitcoin legal tender in September 2021. Since then, the country has witnessed mixed outcomes, with tourism increasing but reports indicating that few citizens utilize cryptocurrencies. Bloomberg reports that the country owns 2.546 Bitcoin valued approximately $76.6 million. Bitcoin has gained more than 80% since the beginning of January due to a variety of causes. Recent bullish factors include the Federal Reserve's decision to postpone the upcoming interest rate hike and BlackRock's application to start a spot Bitcoin ETF. Senators from the United States remain skeptical of El Salvador's push to adopt Bitcoin. According to a May blog post by the United States Foreign Relations Committee, we must seek greater clarity on how the adoption of Bitcoin as legal tender may impact El Salvador's financial and economic stability, as well as El Salvador's ability to combat money laundering and criminal finances successfully. El Salvador's move and the resulting consequences demonstrate institutions' growing desire to include Bitcoin into their finances. Do you believe a Bitcoin-pegged dollar is a viable option? Let us know what you think in the comments area. Don't forget to like, subscribe, and enable notifications. Thank you for taking the time to watch. I'll see you in the next one.